Welcome to the Pump and Dump channel. Today I want to talk about gold and silver, the price development, and look at them as investments in comparison to mining companies who mine the precious metals. Now, just as a quick disclaimer, this is just my opinion. This is not recommendations for anyone to buy or sell their precious metals, their investments. They can do whatever they want with that. I'm not in any business relationship with anyone, so I don't have these kind of worries about people following what I do. So for me, I looked at the spike today, shortly before the open. I saw that it was a really terrible day. Yesterday it was down over 2%. The gold price was down $30 or so, and the silver price was down about 2 to 2.5%. Now, of course, this move up before the open in the US market, I've seen this many times before. The price was pumped up into the open, so the mining stocks that were accumulated yesterday, I could see in the movement that the people were betting on a rebound in the mining stocks. And usually, the people who are buying the mining stocks, when they are very wealthy people and players in the market, they won't take any hesitation to put in a huge green candle on the chart like this that instills hope and reflates the values of the assets that they just purchased. And of course, these precious mining companies, they just sold off after the open. They rallied up and then they sold off. And some of them are trading lower, some of them are trading about sideways. But overall, this move here, this was a pump and dump. I've seen it quite often. And I'm going to go over the metal prices and what I see going forward. Just to take the 1 year chart, we can see that we have a bullish move up. The gold price is still up about 25% from 1 year ago, from the 1200 level when this move up started. Silver lagged a bit behind, but at this point in time in May, July, the traders in gold and silver, the ones who follow this more deeply, they saw the widening gold to silver ratio, and they saw value in buying silver because of the high correlation between the two, and because the gold to silver ratio, it kind of follows a certain path where they kind of trade in sync with that number. And if it's like 85, it will trade maybe up 10, down 10, and then the traders in the two metals, they move from one to the other, and they do their pair trades to gain more metal, because they believe in buying gold and silver coins, and that's a good thing to do. Of course, if someone can do that and they're disciplined, then that's a strategy that can work. Now in the technicals, we can see after this move up, which was driven from my perspective by investors who got discouraged by the low interest rates and now negative yielding interest rates in the Eurozone and other places where rates are very low. Even in the US, they're getting extremely low. So we had central banks and other players coming into the gold market, buying up gold as an alternative investment to bonds. And the silver market in this time period, as I mentioned, it started following suit. And we can see here that this is really a technical move. We have this nice trend line here that then steepens and then goes into a parabolic move. Now, as I mentioned, the fundamentals between gold and silver, they are not identical, but they are very close, and there's many underlying factors that drive the prices. One of them is, of course, the all-in sustaining costs of the miners to produce the metal, and another one is who are the buyers. As I mentioned, the buyers for gold are different than the buyers for silver. And looking overall, we have this nice bullish move up. Some people say it's gotten too high, it's going to come back. We don't know that for a fact, but we can look at the chart to get some indication, and then look at different points in time and see what was happening at those points in time. Now going back to 2000, we can see here there was this nice trend line developing. It accelerated going into the crisis of 2008, 2009, and then it went parabolic in 2010, 2011, when we had stories around the US losing its AAA rating from S&P, I think it was. And at this point in time, the gold price reached 1900. All-in sustaining costs in this time period were very low because of the high-grade mines that existed at that point in time. If you just think back, IAM Gold and some other miners, they had grades above 1 ounce per ton, and in that scenario, exploration was not so successful. Was the probabilities of success were not so high. So, what miners just resorted to was mining the deposit that they had found probably from the time period of the 1980s. The run up in gold price to 850. After that, that probably drove a lot of money into exploration, looking for gold and silver. Now, of course, at this point in time, the grades were high and then exploration was low. So what happened was they just kept mining in the same pits and the prices kept rising because the all-in sustaining costs kept rising, and there's always buyers for gold and silver. It's just a fundamental fact that there are always buyers for gold and silver. So getting into this time period, of course, all-in sustaining costs rose to about 1350 per ton per ounce, and what happened was a lot of exploration companies were set up to find new gold deposits, because at 1350 as a benchmark in terms of cost, they knew historically that they could find mines that would or ore bodies that could become mines that would have all-in sustaining costs around or below $1,000 an ounce. And some of the companies that came out of this cycle here were companies like Pretium Resources. Klondike's gold mines also eventually got into production with their Fire Creek mine, and of course they were taken over by Hecla a few years later after they had destroyed quite some investor shareholder value by continuing exploring and trying to put stuff into production that was not working out so well, and they just kind of failed. And still, the people who bought into Klondike's gold at any point in time before it went above $2 and something, they made money, because they were eventually sold for $2 and change to Hecla Mining. Now, thinking back, of course, at this point in time when those mines were discovered, they were conceived of and then started getting put into production, what happened was, looking forward, investors, smart people, they would have looked and said, you know what, the all-in sustaining cost of 1350 per ounce is going to come down as these come online, and the supply is going to increase. So what we're going to foresee is that the price should come lower, and of course that's what it did. It went into this bear market, and then in 2018, of course, there were several news events around the Bruce Jack of Pretium Resources not meeting the grades as they had initially conceived in 2010-11. They thought they had 15 grams per ton, and then they didn't. They only have like around 12 now. And Guyana Goldfield is another one that had a similar issue where the grades were not what they thought they were, so therefore the ore body is a lot smaller. So this kind of has led to, there's not just this factor, but there's also the negative yielding bonds that is driving the price and the demand up at this point in time. And given the technicals, you can look at this and you can say, well, this looks like it's of course it went up, but here it seems to be forming a cup and handle, and it go to 5,000 because of inflation, because of negative yielding bonds and so on. And I look at this from a contemporary standpoint. We're looking at this negative yielding bonds. This is something that has not existed for any significant time previously. The German bond yield went negative in 2016 for a very short period of time, but it didn't last, and now they're again negative, and I think that ultimately it won't last, and it cannot last, because if you think about it, the people buying bonds and then driving them higher and higher and paying more than they're going to recoup in terms of coupon and principal repayment, they're going to run out of money someday, and then at that point in time their Ponzi scheme is over, obviously. But just to look at this in contrast, we can see here the German bonds current yield minus 64 basis point. So essentially the people buying bonds, they're guaranteeing themselves to lose this percentage year over year, and after 10 years they will have lost over €6.58. The German bond for the 30-year has a much lower negative yield, looks much more attractive than this, even though of course it's unattractive, but if you can only lose 2.64 over 30 years, instead of losing €6.58 over 10 years, I think this would be the better purchase. I mean, with this one, you're really trying to destroy yourself. Yeah. Okay, looking at the futures, gold futures are trading above the spot price, so we're in a contango, which is, nothing to worry about. I would be worried if we were in backwardation with the futures trading lower than the spot price, because at that point that would signify that there's a lot of retail buyers coming in, and the people who are doing the trade, buying spot, storing, and then selling it forward to deliver a few months out, they would just sell everything they had, and then they would buy futures to get gold delivered to them at a lower cost than they're selling now. So they would make too much money at that point of time, and they wouldn't have to work for it. They wouldn't have to do any storing or anything. So that is kind of the situation where a market collapses, and we have backwardation around here somewhere. And we've also had it in other periods of time, but backwardation is something that doesn't happen that often. Now, contrasting investing in gold with gold mining companies, I mean, I went over the technical setup, the fundamentals. I think as I mentioned, the fundamentals say that the negative yields will not persist, so that driver that's keeping the gold price so much above all-in sustaining costs at this point in time is not going to last. And what is going to last is the all-in sustaining costs. They can rise over time, but given where the price is right now, that's not necessarily going to mean that people who buy now are going to make a substantial amount of money over time, because we have to think about the time horizon in which we're holding this. And even if we make $100 on our gold, if we receive it 1 year from now, it's a good return. If we receive it 5 years from now, it's a poor return, obviously. Looking at gold mining companies as a contrast, I went over Guyana Goldfields and African Goldfield on my channel. Here you can see it's down. It's reflecting what the price of gold is doing. The gold price is around 15.15, and this here is priced according to the gold price. But the key why I think Guyana Goldfield is a superior choice as compared to other gold mining companies is that it trades at a 35% discount to the net asset value that comes out of their mine. Now this is really important to think about, because if you buy this company and it has a 5% discount rate, what happens when the gold price falls is that when you have a low discount rate, the value of course falls with the gold price, but if the gold price stays low, this can never really get back to where you bought it, because the 5% discount on the cash flows is going to take many years to get you back to break even. Now, in my video there about Guyana Goldfields, I talked about how at $13.50 gold it had an implied 20% return at the current price of 120, and that kind of is really important to see, because as you can see from those metrics, if the gold price does go down $160 from here, this can still achieve a 20% return over time, whereas something that has a 5% discount at the current moment in time cannot maintain a positive value that will take it above where it is at this point in time. So that's kind of from a analysis point of view. This mining company, I think, even though it's trading at a significant discount for a reason, it has the chance to make it in a gold market that goes down and goes up. African Goldfield is a different story. It has a lot more upside than Guyana Goldfields, and looking at the current price, of course, it also reflects like a 35% discount. It has a new PowerPoint presentation. We can see here August 2019. I looked at it, of course, and found some differences. First difference I found was phase 1, it increased from 2.5 million to 7.5, and includes now these infrastructure upgrades. The company raised the 5 million here in a private placement to cover that gap. at 44 cents and some warrants, half warrants at 60 cents. So the dilution that came out of this private placement was not really strong. Now, on the other hand, looking at the company, I based my valuation on what they had in the 2016 study, implying that with a smaller mine that they designed, well, they conceived of, let's say, producing 50,000 ounces over 8 years, totaling something around 400,000, showing that this is based on the measured mineral resource of 380. Well, they kind of still had 400,000 in the study. It doesn't really matter. The point is that the valuation is based on an ore body that is very small and is going to, be produced over 8 years at 50,000. But as I mentioned, Stan Barty, the new CEO, he's putting boots to action. He's appointing and signing contracts with companies to do the drilling, the sampling, look at the metallurgy, and he's getting this thing rolling. The target, of course, is to drill. They want to obviously try and increase the categories of indicated and inferred into measured, proven, and probable. So they want to drill and see whether this 400,000 ounces of gold can be increased to 2 million to give a big deposit. And if they can do that, obviously the share price, it won't really matter what the gold price does, whether it's at 1350 or whether it's at 1600. This finding, discovering that they have more ounces than they initially can see from the feasibility study that was done in 2016, they will definitely have a higher valuation for the company, because the exploration success in finding ounces is so much greater than the cash flow that you can generate from mining ounces that you already know about and already factor into your net present value calculation. So for me, looking at the gold price, I think that I don't know where it's going to go, whether it's going to now come back down into the 1400s or whether it's going to keep running and making a new high and going to 1700. It really depends on what happens with these negative yields on bonds and with investor sentiment. Personally, I wouldn't be buying gold here. I would be buying something like this, a gold mining company that can succeed in the environment that exists at this time with this $1,500 gold price, and can even succeed in a lower gold price environment. That is the key to investing, is to look at your upsides and your downsides and then see whether you can still make money when your downside realizes, and see how much more money you can make if things stay stable and they materialize in your favor. So I'm going to leave it with that. Remember, this is only my opinion. It's not investment advice. I'm not telling people to buy this stock or buy the other stock. I think that we can see that there are reasons not to buy it. Number one, this private placement that was previously signed, and they kind of got their shares now, these investors, these 14 million shares plus one common share purchase warrant. And if we look in the chart, we can see here that in the month of August, over 16 million shares were traded. On the 1 year chart, we can see it better. There's like over a 2-week period here where something like 14 million shares were traded, and from my perspective that was most likely linked to this private placement by these people. Then again, it doesn't matter. We have to just look at the company as it stands. Is it a buy? Is it a sell? For me, I bought some of, obviously, I talked about it at 25 cents being worth 37 cents, and I'm sticking with it. I'm going to see what happens. I'm pretty convinced that something good will come out of this in the next few months, and from there we will see whether I hit a home run or not. And of course, one thing to consider is, if it comes down, will I buy more? Absolutely. If nothing has changed, I will definitely buy more. I didn't buy too much because I'm trying to see, as things go on, develop my knowledge about this company and the asset. It's not always easy, especially looking at those technical reports. A lot of things are put into a specific context that normal people who don't specialize in this industry cannot really understand, and therefore you miss lots of, warning signs that say get out or get in, and that's kind of where it's at. So yeah, let me know what you think, guys. Do you think that investing in these companies is going to, do me worse than buying the metals? On the daily chart, we can see here that this move up, yep, and there it goes down again. This was just a pump and dump. This is a spike move. I don't believe in spike moves in down markets. Yesterday was a down day. Today was a down day until this happened, and I don't know. But for me, looking at this chart, just as an example, I drew this line here. For me, it's hit that resistance line, bounced off, and now it's coming down to these levels. And will it be at 16 or 17? I don't know. I certainly don't hope it will be, because of course I bought some silver coins a few years ago, and I don't want them to lose value. But that's how it goes, and that's just the way the investment world is. I'm really feeling good about these companies here, and when the price goes down, because the gold price is coming down, I won't be really bothered because I know what I bought. It's not like if you buy something, speculative or something really complex, and then the price is down and you don't know why. It can be related to it being overvalued. It can be related to you buying at the wrong time. And yeah, it can be anything. Just remember that. So don't get melted in the stock market, and have a good day.